If you hold less than 50 ounces of silver right now, this is not just another market update. This is not entertainment. This is not hype. This is not a prediction contest. This is a strategic briefing designed specifically for a small stacker navigating a market that just shifted under your feet. Everything changed in the last 24 hours. Not gradually, not subtly, not over months. It shifted in a single session, and the consequences of that shift are not the same for someone holding 500 ounces as they are for someone holding 12 ounces. They are not the same for someone sitting on monster boxes as they are for someone with a small pouch in a drawer. If you are under 50 ounces, the math hits you differently. The volatility hits you differently. The premiums hit you differently. The mistakes hit you harder. And that is why you must think differently. Comment below and tell me what price per ounce you bought at last time. Let's see who in our community has stacked the most ounces. Now, let's return to what's quietly shifting beneath the surface. When price explodes upward in a single day, the first emotional reaction is urgency. The fear of being left behind. The fear that the train has left the station and you are standing on the platform holding too little. That emotion is natural. It is also expensive, because when price spikes, premiums spike with it. Demand surges, dealer spreads widen, inventory tightens, shipping times extend, and small buyers, not large institutional players, absorb the highest proportional cost. If you hold 20 ounces and you overpay by $3 per ounce in premium during a frenzy, that mistake is not trivial. It is not background noise. It becomes a measurable percentage of your total position. It becomes a drag on your long-term average. It becomes something that compounds against you. A large holder can afford imprecision. A small holder cannot. Under 50 ounces, every dollar matters. Every premium matters. Every timing decision matters. Because your stack is still in the phase where each additional 5 or 10 ounces significantly changes your average cost basis. If you own 15 ounces and you add 10 more at a poor entry, you have just reshaped your entire position. You have shifted your average dramatically. That can be good if you are disciplined. It can be destructive if you are impulsive. Right now, the most dangerous impulse is panic acceleration. When price surges 5 or 6% in a single day, history shows that short-term pullbacks are statistically common. Markets breathe. They expand and contract. They overshoot and then retrace. The emotional peak is often followed by a cooling period. If you deploy all available capital at the emotional peak, you eliminate flexibility. And flexibility is the most valuable asset a small stacker possesses. Because flexibility allows you to average down. Flexibility allows you to exploit dips. Flexibility allows you to respond to sudden premium compression. Flexibility allows you to adapt. Without flexibility, you are reactive. With flexibility, you are strategic. Small stackers must think in tranches, not blasts. You do not fire all capital at one price. You divide, you stage, you layer. If your monthly allocation is $400, you do not drop $400 in a single transaction on a spike. You break it into 4 segments. You deploy weekly. You smooth volatility. You reduce regret. You eliminate the binary outcome of perfect entry versus terrible entry. Because markets are not binary. They are probabilistic. Now let's talk about product selection, because this is where small stackers quietly bleed capital. When premiums widen, the most recognizable products often carry the heaviest markups. Beautiful coins, government stamped designs, highly recognizable pieces. They feel safe. They feel premium. They feel like the obvious choice. But under 50 ounces, you are not building a display case. You are building weight. Weight matters more than aesthetics at this stage. If one product carries a $6 premium and another carries a $2 premium for the same purity and weight, that $4 difference per ounce is enormous when you are stacking in tens, not hundreds. 10 ounces at a $4 savings is $40 retained. That $40 is nearly half an ounce at elevated prices. Half an ounce today becomes more later if price continues rising. Small differences compound over time. This does not mean you avoid recognizable products forever. It means you prioritize accumulation efficiency while your base is still forming. Once you cross higher thresholds, premium becomes less significant proportionally. But below 50 ounces, premium is not cosmetic, it is structural. Now consider timing. When markets surge, dealers often experience order floods. Shipping delays increase. Buyback spreads widen. Emotional demand peaks. 2 days later, traffic cools. Premiums sometimes compress. Inventory stabilizes. Patience is not weakness, it is leverage. Waiting 24 to 48 hours after a spike can mean entering at a lower spot price, a lower premium, or both. For a small stacker, that difference can represent multiple percentage points of total position value. Multiple percentage points are not noise when your stack is modest. They are meaningful. Now let's zoom out to the macro environment. Inflationary pressures are not abstract. They show up in groceries, energy, rent, and imported goods. When trade barriers rise, costs ripple through supply chains. Businesses pass costs forward. Consumers absorb them. Currency purchasing power erodes gradually, then suddenly. Holding savings in cash during an inflationary wave guarantees a slow bleed. Interest rates rarely outpace sustained inflation. Real returns turn negative quietly. Silver is not just a trade. It is monetary insurance. But insurance must be purchased intelligently. Buying recklessly defeats the purpose. You are not trying to chase a chart. You are trying to preserve purchasing power across years. And preservation requires discipline. Under 50 ounces, your goal is foundation building, not speculation. Foundation building means consistent allocation, low premiums, documented purchases, secure storage, no leverage, no debt-funded buying, no emotional surges. Leverage is poison for small stackers. Borrowing to buy volatility is a recipe for forced liquidation during corrections. Debt interest is guaranteed loss. Silver appreciation is not guaranteed gain. If you carry high-interest debt, eliminating that debt may provide a better mathematical return than adding more metal. A guaranteed 20% saved is stronger than a hoped-for 20% gain. This is not glamorous advice. It is rational advice. Now let's address volatility. Silver can move 5% in a day. It can move 10% in a week. It can retrace violently. If you cannot emotionally tolerate a 20% drawdown without panic selling, you are over-allocated. Small stackers must size positions so that volatility does not trigger liquidation. If you would need to sell in an emergency within weeks, you are not holding metal. You are holding a ticking stress device. Capital placed into silver should be capital that can remain untouched for at least a year. That time horizon transforms volatility from threat into opportunity. Now think about divergence between paper pricing and physical tightness. Physical markets can experience strain even when futures markets fluctuate wildly. Premiums reveal stress before spot does. When global demand accelerates, physical availability tightens first. Retail investors see it in rising premiums and delayed shipping. As a small stacker, you must watch premiums as closely as spot price. Premium expansion can signal stress. Premium compression can signal cooling demand. Both are actionable signals. Now storage. Under 50 ounces, your entire stack may fit in a small container. That does not make security optional. Photograph every piece, record dates, record prices, store digital copies separate from physical location. If disaster strikes, documentation matters. Security is not paranoia, it is responsibility. You must also guard privacy. Broadcasting holdings publicly invites risk. Discretion protects capital. Now perspective. If you hold 12 ounces, that is 12 more than most people. If you hold 25 ounces, that is a meaningful reserve. Comparison destroys discipline. The goal is progress, not competition. Large stacks are built ounce by ounce. Every disciplined purchase compounds. Every avoided premium spike compounds. Every patient entry compounds. Small stackers win by precision. You are not late. You are early in your own accumulation curve. If price continues rising, your existing ounces appreciate. If price pulls back, your staged capital buys more weight. Either outcome can be navigated intelligently, but only if you resist the emotional spike. Right now, the most powerful move is restraint. Let the dust settle. Let volatility breathe. Deploy capital in stages. Choose weight over glamour. Protect liquidity. Avoid debt. Document everything. Think long-term. Under 50 ounces is not a weakness. It is a stage. Build correctly at this stage, and future growth becomes easier. Rush this stage, and you will spend years correcting mistakes. The foundation determines the structure. Move carefully. Move methodically. Move with math, not emotion. Now we need to talk about risk management at a deeper level, because small stackers face a unique psychological battlefield. When you hold 300 ounces, a 10-ounce purchase feels incremental. When you hold 18 ounces, a 10-ounce purchase feels transformative. That emotional intensity increases the temptation to time perfectly. Perfection is a myth in volatile markets. The objective is not perfect entry. It is resilient positioning. Resilient positioning means you can withstand both upward acceleration and downward shocks without regret-driven decisions. Regret is the silent destroyer of small portfolios. Buy too high, price dips, regret triggers fear. Wait too long, price rises. Regret triggers chase buying. Both lead to poor sequencing. Sequencing matters more than prediction. If you sequence purchases over time, you neutralize the emotional burden of getting it right. This week, volatility probability is elevated. Rapid moves often produce aftershocks. Aftershocks create opportunity for staged buyers. If price consolidates, you gain better averages. If price extends upward, you benefit from what you already own. This dual advantage only exists if you preserve capital flexibility. Now, let's discuss liquidity. Small stackers sometimes overlook exit strategy because focus is entirely on accumulation. But liquidity profile matters. Highly recognized forms of silver typically resell faster and at tighter spreads. However, during extreme demand periods, even generic rounds move quickly. Your goal under 50 ounces is balance, low acquisition premium with sufficient recognizability for resale. You do not need exotic designs. You need liquidity efficiency. Keep receipts, track acquisition cost, know your break-even, including premium. When price moves, you will understand true profitability rather than guessing. Now consider allocation within total net worth. Silver should not represent emergency rent money. It should not replace cash reserves. It should complement them. An emergency fund remains essential. Market turbulence can create job instability, unexpected costs, or sudden liquidity needs. Selling silver under stress eliminates long-term benefit. Proper structure is layered. Cash for short-term emergencies. Debt elimination for guaranteed returns. Silver for long-term purchasing power preservation. This layered approach reduces panic probability. Next, understand volatility cycles. Sharp upward moves often attract momentum traders, who are not long-term holders. When their short-term objectives are met, they exit, causing pullbacks. Pullbacks are not thesis failures. They are structural features. Small stackers must train themselves to view pullbacks as data, not disaster. If price dips 8% after a surge, that is not betrayal. It is market breathing. If you are staged, you welcome breathing. Now think about compounding ounces over years. 10 ounces added quarterly equals 40 ounces per year. 5 ounces added monthly equals 60 ounces per year. Even 3 ounces monthly equals 36 ounces annually. Under 50 ounces today can become over 100 ounces within a year through disciplined consistency. But that only happens if capital is not wasted on high premiums and emotional surges. Precision early accelerates growth later. Now let's address mindset. Small stackers often feel behind. That sense of urgency creates overextension. Overextension creates vulnerability. Your advantage is agility. Large holders cannot pivot easily. You can. You can adjust product type quickly. You can change dealers quickly. You can alter weekly allocation quickly. Agility is power. Use it. Monitor premium spreads across multiple sellers before each purchase. Even a $1 difference per ounce matters at this stage. Over 12 purchases in a year, saving $1 per ounce on 10 ounces each time equals $120 retained. That is multiple additional ounces over time. Small efficiencies compound into significant differences. Now, consider long-term macro pressures. Inflationary cycles historically elevate tangible asset demand. Currency debasement erodes savings slowly, then visibly. Silver historically exhibits periods of stagnation followed by explosive repricing. Explosions are rarely linear. They are chaotic. Your task is not predicting the exact moment of repricing. It is ensuring you hold sufficient weight before repricing accelerates. Under 50 ounces, you are still in accumulation phase. That phase demands discipline more than bravado. Never allow a single news cycle to dictate your entire allocation. Never allow a single surge to exhaust your reserves. Never allow social momentum to override math. Math is your anchor. If your budget supports 8 ounces per month sustainably, buy 8 ounces per month sustainably. If it supports 5, buy 5. Sustainability beats intensity. Now, let's address security again, because as value increases, so does risk. As your stack grows, reassess storage. Diversify storage locations if appropriate. Avoid discussing specifics publicly. Discretion protects long-term stability. Small stackers can upgrade storage incrementally. Start simple, but intentional. Documentation protects against loss and dispute. Insurance may be appropriate, depending on total value and risk tolerance. Now, think in 5-year horizons. Short-term volatility fades in multi-year charts. Consistent accumulation becomes visible. If price doubles over years, early disciplined ounces deliver exponential benefit relative to their initial cost. But only if you still own them. Impatience leads to churn. Churn leads to lost ounces through spreads and fees. Buy deliberately. Hold calmly. Add strategically. You are not racing anyone. Under 50 ounces is not a verdict. It is a beginning. Every large reserve began small. The difference between stagnation and growth is not luck. It is structured repetition. Structured repetition means budget defined, allocation divided, premium compared, purchase executed, documentation updated, storage secured, repeat. No drama, no hero trades, no panic spikes, just repetition. If price runs dramatically upward, your base appreciates. If it corrects, your staged capital expands the base. Either path strengthens you if you operate systematically. Small stackers win by removing chaos from their decision tree. And remember this, ownership of tangible metal in uncertain monetary cycles is already an advantage. Most people hold 0. You hold something. Build on that advantage intelligently. Under 50 ounces is not a limitation. It is a phase that rewards precision, patience, and discipline. Do not chase. Do not panic. Do not exhaust your flexibility in a single emotional moment. Build in layers. Protect your capital. Reduce premiums. Eliminate debt. Stage your entries. Secure what you own. And let time, consistency, and math work in your favor.